Mitch, are you talking? Sorry, I could not hear Mitch Kramer.
Me either.
Yeah. No, I apologize, guys. I had my mic on mute. We'll get the technology right one of these times. No, anyway, what I wanted to talk about today, these are the topics we're going to go over on the call. But one of the things I wanted to add, in addition to asking questions, you've got this speech when you can kind of type questions in. Think about things that you've heard of or people in your neighborhood that have done something really nice for the community, because there's a lot of great stories out there, because we've been through a lot of tough and difficult times, and because of that, a lot of people really are hurting and struggling, but other people have kind of risen to the occasion to help out our fellow men and women. Here, these factories that have reconfigured their machinery to make face masks or PPE equipment. And I think those are some of the great stories that the media doesn't pay enough attention to. The media has a tendency to focus on whatever bleeds leads. So on the call with me today, I have Mike Lanise, the portfolio manager, and Tabitha Garaf, our director of operations and financial advisor, and she's going to be chiming in, or they both be chiming in throughout our presentation. So to kind of go through the topics on our call today, we're going to go through the overall economy. I have an 165 pound organic alarm system called Indigo, and he's making his announcement. Anyway, we're going to go through the energy and oil market, the equity and fixed income, or the bond markets. Specific Americans are really hurting. We're going to have an update on the COVID-19 update, the cost of opening and the cost of not opening, the keys to success, and then we'll finish with the wine tasting. And we're putting these slides together, and some of you guys I've been talking to, maybe we need to do a whiskey tasting for the next quarter. So you can comment on that on the survey, and please answer the survey that Taylor will send out at the end of it. So the first slide I want to go through is we're going to have a recession this year. We're going to have one for the first quarter and the second quarter, and we're probably going to be down about negative 1.3% for 2020. ITR Economics, I'm going to have a number of their slides in our presentation today. They've been around since 1948, and they have a very high accuracy rate of predicting business cycles. And they think we're going to have a 2-week or a 2-quarter recession, then a kind of a recovery in the third and the fourth quarter. 2021 will be a much stronger year than kind of a slowdown in the 2022. This slide's very dense. You don't need to read it. We're obviously going to have this posted on the Orion underneath the Updates tab. But what I want to focus on is this V recovery. And we've heard about this V recovery, and we will have one. It's not going to be a U. It's not going to be an L. It may be a check mark, but it's not going to be extended. Now, certain segments of the economy are going to take a lot longer to recover. I won't talk about the hospitality sector. But it basically just shows we're going to have a slight downturn in the GDP, but it's nothing going to be like 08 or 09. And kind of following the same theme, the consumer price index, you're going to see it fall through deflationary pressures for most of this year. And this is mainly the collapse of the oil market. And people aren't going to be spending as much money, so prices are going to drop, not significantly, a little bit. They'll start rising back up to 1.7 next year, and then 2% after that. And 2% is kind of the long-term expectation for inflation. We are going to have significant inflation in the future. With the amount of money the Federal Reserve has printed and our government is asking them to print, the trillions of dollars that have been interjected, there's going to be a cost that's we're all going to have to pay for. And these guys, ITR economists, the Bolio brothers, have written a book called Prosperity in the Age of Decline. It's a great book, and they're Austrian economists, and they think the 30s are going to be a very difficult decade for the United States and the world. One of the key things I wanted to share with you here is some of the ways they look at their cycles. They look at business cycles in 4 categories, and there's the bell-shaped curve: recovery, accelerating growth, slowing growth, and then a recession is here in the red. So I'm going to show you some slides of certain segments of our economy and where they are, where they expect them to be. So the first one is the overall core U.S. economy at a glance. And if you look at the year over year, the 12-month, it was in a descending trend. For 2021, 2020, 21, and 22, these are where the business cycles will be at the end of the year. So across the board, we're going to be still in a recessionary period at the end of the year for these various sectors of the economy. I won't take our time and read through all of these, but we had a double black swan event, and our economy is going to take a hit, but it's not going to be down for an extended period of time. And I think one of the reasons why you see the equity markets recovering as much as they have is they recognize there is light at the end of the tunnel. And one of our webinars, we talked about when the unknowns become knowns, and the market's going to be 3 to 6 months ahead of the overall economy. So the next one is the manufacturing sector, and this is very similar to the prior slide. Primarily, most of these indices are going to be in a recession. You know, kind of ironically, the defense sector, they expect to have a really good 2020, then a recession in 2021. Not really sure what that means. Hopefully we don't have any military activity with, you know, the world kind of in a beaten up shape. Obviously, you would expect that the aircraft industry, you know, specifically Boeing, is going to take a huge hit this year. And at the end of 21, they're going to be in a recovery phase. So they're going to be in a recessionary period for quite some time. And it makes sense. People are not flying. Airlines aren't making money. How can they afford an airplane? So that's one sector that's going to take a longer time to recover. We don't have the service sectors in here in hospitality, but I'll talk about that here in a minute. The construction is going to be one area of the economy that's not going to be hit as hard because it's been deemed a necessary industry. So maybe a lot of the road construction and bridges with not as much traffic, they'll be able to get the roads fixed better. Those of you that live in the inside loop of LBJ of Dallas would probably love to see the roads get fixed and the potholes get fixed or patched. So this industry will not be taking a big hit. Private office construction and then education is going to be in a recession this year. I think the colleges are going to have some very big learnings coming out of this, with so much people learning online, and the online cost is significantly less than tuition you pay. And so colleges are going to have a day of reckoning, and hopefully going forward, for those of you that have children in college or will be going to college or grandchildren, maybe the colleges will finally get wise and not be raising their prices 5 to 7% every year, because they know if you don't pay it, there's 300 people in line behind your child that will. The municipalities are going to have a tough year. You have decreased revenue. People are out of work. They're not paying taxes. So municipalities are going to have a tough year, but in 2021, it get better. When you look at the global perspective, and again, it's very similar to what you guys saw before. Everyone's going to have a tough year, then 2021 will be better. You know, China is here at the bottom. They do a lot of industrial production, and you guys have heard me on my prior calls. China has never been known as an honest country. And I think as we see more and more news that comes out about China, I know we talked about this in prior webinars about the origin of the coronavirus. It was not from a wet market. It originated from a lab, and that's now becoming more mainstream. And I'm not saying it was a bioweapons lab. I think it was somebody being careless with their medical protocols, and they got infected by a bat, and then they spread it to their family. Then it went on from there. What's been embarrassing is that China has covered up patient zero and a lot of that information. So China has a lot of blood on their hands. This slide here is about retail sales. And again, this would be expected. If you look at all of the negative information in all of these retail establishments, bars and restaurants, look at clothing, a 50% decline, 1 month change. Most of these are worse since the recession of 1992. Second worst on record for gas stations. And then you can look at areas which are doing really well: food and beverage services, general merchandise, healthcare, and the non-store online. So you look at the Amazon, Walmarts, those kinds of companies have benefited during this downturn. And now I'm going to turn this presentation over to Mike, and he's going to talk a little bit about what's going on in the oil market. So Mike, take over.
Thanks, Mitch. Okay, so we've talked in the last couple of weeks about the double whammy that's being hit in the oil market. The high of the market was February 19th, and that's when the coronavirus really came out. That Friday, I believe, was February 20th or 21st. Market started going down, and then over the weekend of March 6th through 9th, that's a Friday through Monday, Russia decided to ignore OPEC cuts, OPEC oil production cuts, and Saudi Arabia said, okay, we're just going to flood the market. So you have demand going to almost zero and supply going through the roof. Obviously, oil prices were going to crater. So I think a good takeaway from this is you look at those estimates. They were looking at the oil prices bottoming out in Q2 of 2020. Well, we are in Q2 of 2020. So both the Saudis and the Russians need a higher oil price to sustain their economies, and $20 a barrel is not it. So they have cash reserves built up, but what they're doing right now is burning through those cash reserves if they're going to keep producing oil at these prices. And I have talked to an oil expert that said that about $18 is the bottom for oil, not zero. Oil's not going to zero, because at $18, the refineries just turn off. They say we're not gonna produce anymore. So I feel like we are close to the bottom on that. I think cooler heads will prevail between Russia and the Saudis. I will say this: I am not fearful that there's going to be a reduction in demand for oil. We're already at the bottom. There is no demand. So the fact that demand might go lower, no, we're here. We're at the bottom. We might bounce around here for a little while. But so we'll see how fast they want to go through their cash reserves. I highlighted on this slide. When their cash reserves are gone, they're gone. You know, they built those up when oil. Go ahead.
And I think an important point, Mike, to make to our clients and friends. Oil, you know, think we're at the bottom of the ocean. Yeah, there may be a little ravine. We may go down a little bit, but we're there. And the stocks have already priced in what's out there. The stocks have priced in this low oil level for the foreseeable future. But the key point is in the 6 positions that we own, none of the companies have said they're going to cut dividends. And what they're doing to preserve cash is they're minimizing exploration. They're not buying back their stock, which they probably really shouldn't do anyway. And that's another argument that I agree with the left on. The companies shouldn't use money to buy back their stock and artificially goes up. But you're getting some really, really good dividends and income, especially when you look at the alternative in the bond market. You're getting no yield whatsoever. So we'll talk a little bit more about that later. So go ahead, Mike.
All right. So I'm going to go on to the next slide here. Okay. Okay, so an announcement was just made this past week that the Russians and the Saudis are going to take 9.7 million barrels of oil off of the market, but demand is down something like 20 million barrels a day. And I apologize, my yard folks decided to show up when it was my turn to talk. So if you hear the blower and weed whacker outside, I do apologize. But on this chart, I think it's important to note the 4th bullet point. So we're going to have steep capital spending cuts by the oil companies, like Mitch just mentioned. They're going to preserve their dividends. So what they're going to do is going to cut stock buybacks, and they're going to cut back on capital spending. But then your demand is going to come back, and 2021 is going to be a nice year. So I highlighted in that lower right-hand corner what will be a V-shaped recovery between 2020 and 2021. But this could also be a problem. If you look at the final bullet point here, talks about OPEC and the end of 2020, especially into 2021. If these companies do a short-term, short-sighted reduction in production and exploration of oil, you could possibly see a shortage going into 2022, and that will really spike oil prices. So you guys understand that oil markets have always been boom to bust and back again. So I think you may see that here between 2021 and 2022. Okay, so this is what's happened, the impact on the coronavirus has had on the S&P, and I highlighted here the high point was February 19th to the upper middle part of your screen. Since then, in 23 business days, you can see the S&P has gone down just over 35%, where it started bouncing off of its bottom that Monday, March 23rd. Since then, now this is through 2 days ago. This is through Tuesday's close. The market is up just about 30% from there. But you have to realize that if it goes down 35% and back up 30%, you're not down 5%. If you look in the middle there, that's a 16% drop in the market from where we were. So if you closed your eyes and fell asleep for 2 months, I mean, look at that. Look at the cycle: 23 business days and 15 business days. That's a month and a half, and all of a sudden we're down slightly. I called down 16%, down slightly, because we still really haven't said, okay, we're starting to see the light at the end of the tunnel, but we haven't said restrictions are going to start lifting. Demand is allowed to start coming back. When you see that, then I really think you're going to see this curve move in an upward fashion. So this has been an incredible cycle that we've been through. And one of the best things you do in something like this, it's panic driven, is just stay off of it. We were able to get some very good values, and I think some values still persist out there. Okay, so how have our portfolios held up with the energy holdings? So energy over this time has been decimated. Oil is down over 55%. And if you look in the lower left-hand corner, these are our three main stock portfolios. So our ADVP portfolio has 15% energy holdings, half of what the VNO holdings are at 30%. That's our large stock portfolio, and our largest holding is energy stocks. And then your stock income portfolio, for those of you in that, it's a 20% holding between BP and Chevron. Look over at the very far right of this. We have two columns on the very far right, and it shows you what happened in the markets during that dip that we just looked at on the previous page. So from Feb 20th to March 23rd, the S&P is down just about 34%. So the S&P is down 34% during that time, and every one of our portfolios that has energy holdings, and energy's down 55%, did better than the S&P. And that speaks to the solid balance sheets that the Chevrons of the world have. Then you go and you look at the recoveries. Since then, the markets have recovered 24.4%, the S&P has. Oil has not recovered at all during that time period. And if you look, how far are we off of that 24.4%? ADVP is right about 23%, 23.6% for VNO. I mean, we are in the ballpark, and oil hasn't moved yet, and those are our largest holdings. So I think we are in really good shape right now for when that oil market does recover. Let's go to this next slide.
Yeah.
Mitch, I'm going to go ahead and pass it back over to you now.
Okay. Yeah, thanks, Mike, for the update on oil. The next thing I wanted to talk about is the negative yielding debt around the world. This was already a problem before we got into this, especially in other countries. And if you look at the chart here on the bottom right-hand side, we have about 25% of the world's debt has a negative interest rate. So it's like a lockbox fee. You're paying an entity to hold your money. You go to Germany, want a 10-year Treasury, you're going to pay them about 60 basis points or 0.6%. If you look at the U.S. 10-year, we're at 0.7, and there's very few bonds that are above 1%. So you're getting no yield on government debt. And then you say, well, let's look at the overall, or let's look at the United States. And here's the Treasury market up here. This is a dense slide, so I just want to highlight a few areas here. So here are U.S. Treasuries. And a 30-year bond is paying 1.35%. Now, we're in a deflationary period this year, but long-term inflation for the near term is probably going to be 2%. None of these are beating inflation. and these are safe bonds. So why would you own them in your portfolio? Well, you use them for diversification purposes in our mono portfolios, like growth with income, income with growth. We have these kinds of instruments. And then what they primarily do is they move the opposite way of the stock market. This is what this correlation column means. So it has a negative number, so the market goes down, these will go up. And a lot of people say, well, we're going to have lots of inflation, we should have tips in our portfolio. Well, if you buy tips now, you have a negative yield on it, so that's not an opportune investment. What my concern is, you come down here to the corporate area, and these are the corporate bonds. They have obviously much higher yield, and if you look at the convertibles and high yield, you're looking at the losses year to date here about 13%. This is through March 31st, and very high correlation to the stock market. So people that own convertible bonds in their portfolio, we're not using them. You're basically buying a stock in sheep's clothing. But the important part here I want to get across, there was when the Federal Reserve expanded their balance sheet by another $4 trillion, they gave a lot of money to these large financial institutions, and they decided they're going to do some quantitative easing. And one of the programs they started was buying high yield debt. So what they were doing is putting a floor in high yield debt, which is this sector right here. And so they're putting a floor on this, but guess who is one of the biggest holders, if not the biggest holder of high yield debt in the country? It's BlackRock, the same entity that the Federal Reserve has outsourced a lot of their asset management to. So it's a huge conflict of interest, and this doesn't get any media play in the Fox News or other areas, and this is a problem. So you see some bad things happening at high levels. In one of my beefs, and we talked about this in the CARES Act, if you're a huge institution too big to fail, you get money within hours or days. If you're a small business owner like those of us on the call or myself, we go through the PPP loan program, and we have to wait in line 2 weeks, and we don't get anything. So that's a challenge that's going on here. So then if we look at the yield of the Treasury yield versus the stock income portfolio, getting some feedback here.
Yeah, can you guys make sure your phones are all on mute?
I have them all muted.
Okay.
Okay.
All right. So thank you. So the 10-year Treasury yield, 0.746, and the stock income dividend yield is 4.68%. And these are the dividend yields of the stocks in the stock income portfolio. So these are stocks that pay very good dividends. And here's BP, a 10% dividend. They've indicated they're not going to cut their dividend. Altria, another one that's in here, Chevron. Chevron's CEO 2 weeks ago reaffirmed its dividend. So why the oil market's kind of bouncing along the bottom, you're getting paid these dividend yields while it recovers, and the people that are in this particular portfolio, and again, for those of you not in it, it takes $1 million one portfolio to get in this, you're getting paid quite a bit of money to wait while the energy sector and these other sectors recover. And this is only 20% of the portfolio. I think Amgen and GlaxoSmithKline had a real big day today in the market from what I saw.
Mitch, I just want to add that ADVP and VNO have all of these stocks as well, except for GlaxoSmithKline that we get in and out of at various times.
Okay, fantastic. All right, and great segue, Mike. Why don't you talk a little bit about some specific logistics and some of the things you've done with the stock income portfolio, how we're trying to minimize getting called away when markets go down.
Okay, so I used Amgen here, and so Amgen is one of the 10 holdings that we have in our stock income portfolio that Mitch just showed you on that previous slide. And basically, if you look back here from the beginning of September, as Amgen goes up, we sell calls on Amgen, and I go out to the marketplace and I offer your shares, if you're in this portfolio, to the marketplace, and they have to pay you for the right to buy your shares from you. So if we use in this example, so here's the 220 line here where my mouse is. If I agree to sell the 230 calls up above it, the next block up, and the stock ends up at 240 while we're forced to sell out at 230. So it can be good in flat or boring markets. As the markets go up, sometimes we are forced to sell. And the reason I bring that up is because we were forced to sell a couple times earlier in late 2019, and we ended up repurchasing Amgen around the $243 mark. So that became our cost, and I kept selling calls. Well, going sideways from there, you can see that I was selling. You can see the market didn't keep going up, so we weren't forced to sell out of the position. Well, then comes the S&P high water mark. I marked it with a little circle here. Mitch, I don't know if I'm controlling this. Oh, yes, I am.
You are. You got it.
S&P high water mark there. That's the Feb 19th. From Feb 19th through the March expiration, stock income, we try to generate 1% a month, 12% a year on cash. So for every $1 million, we're trying to generate about $120,000 for you for the year. We only generated 0.18%, obviously much, much lower than we would have liked. But I was just sitting there holding on because I thought, okay, we have the virus, stock market is tanking, don't do anything stupid. If I went ahead and sold your stocks, the next day the market's up 3,000 points and we get forced out of them, I just locked in a loss of the $243 to wherever we were forced to sell them. So after we hit that bottom on March 23rd, I wasn't sure how long we were going to stay there. Obviously in this chart, you can see that we didn't stay there long at all, but I wanted to start generating income again. So between that low water mark on March 23rd and through Tuesday, we generated 0.95%. So we're just slightly below our 1% target on it. To get that, here's what I did. I agreed, so this top center here, I sold the April 190 calls. They expire tomorrow on Amgen. I'm just using Amgen as an example. We've done this times 10 with the portfolio. So I sold the April 190 calls. Well, Mike, you're an idiot because our cost basis is $243 a share. You just agreed to sell our Amgen at 190, locking in that loss. Kind of. What I also did was I took the proceeds from that and I also bought calls at 200. So we may be forced to sell out at 190, but if the stock market took off on me, I'd be able to buy the shares back at 200. And that's what it did. Okay, well, selling at 190 and buying back at 200, you just gave away $10 of our money. That's correct. But I also received $4.52 for it. So instead of losing $10, we lost $4.50. Again, this is not ideal. I did not want to lose money on this, but as of tomorrow, we'll be back into Amgen and we'll have that basically a $5 loss. Now that's only on half of our position. So $5 on a $200 stock, that's a 2.5% loss. But we only did it on half of our position. So that's that's 1.25%. Prior to this whole thing, we were averaging over 1.5% in stock income. So that is a loss that is very easily recoverable in 1 month on this portfolio. And we've already generated 95 basis points, almost 1% this year. So we'll get through this. This market's going to keep going up, and we've just experienced almost one of the worst financial crises since the 2008 financial crisis and the Great Depression. And this stock market, this portfolio is still making money and still generating some income. So I think we're very close to being back to normal and generating some great returns on this portfolio. Mitch?
Great. Yeah, thanks, Mike. Oops. In kind of talking about the market, what I wanted to show you guys here, this chart shows the market is up 75% of the time. So 30 out of 40 years, the market is up. The bars represent what did the market finish the year at as of 12/31. The red dots represent the low water mark for that year. So for like this year, we got down 34% on March 23rd. At the end of the quarter, we were down 20. What's kind of interesting is we've only had 4 periods of the last 40 years where the market's been down 34% or more. ironically, you have 334%. That's kind of a coincidence. And then, of course, the 2008 when it was down 49 and finished down only 38%. Now I want to kind of transition into a concern that I have. And this is a slide we've talked about in our meetings, and I'm going to bring it up again because there's something we're going to do at Fluent that I'd like to have some of you all participate in. Most of the people or everyone on this call is going to be in the top 10% of income earners in the country. And what this basically says is you basically spend 69% of what you earn. The other 31% is either donated, saved, etc. The people in the bottom 90%, and this is as of the end of March. Now, these numbers are identical to as of year end, so they haven't changed. Maybe it doesn't reflect the layoffs and people being unemployed. But the people in the bottom 90% are spending 101% of their paycheck. So how do you do that? Well, that's credit card debt or getting assistance from family members. And that's how they pay their bill. That's why gas prices are such a critical component for Americans and the impact on the economy. But now we're going to have unemployment rate in double digits in the hospitality sector. That area has been decimated. We now have a large numbers of Americans showing up to food banks. And what I want to talk to you guys about is that I saw a news story on local news earlier this week, or maybe been last week. The days kind of run together. But the story basically said that over 50% of the people going to the food banks, that's the first time they'd ever gone. And we know there's a hunger problem in this country that's underreported, but now it's a huge problem. So what I'm announcing today on this call, we'll send an email out to all our other clients who aren't able to attend the call. Fluent Financial is going to put up $10,000 in matching funds. So anyone who decides to contribute to the North Texas Food Bank, and we have a link on one of the slides at the end, you can copy, take a picture of it with your phone or review this on the Orion page. We're going to match it up to $10,000 because I think that's a very small token to help out some people who are really in need, because there's a lot of Americans out there that are hurting, and I just think that's a small token we can do to help out. And to that end, here's the hospitality sector. You look at this slide here, upper left-hand corner, consumer spending by industry. This is retail. These are your stores, excluding restaurants and bars. You got sports teams, airlines up here. It's about almost 20% of GDP is shut down, and they're not making hardly any money at all. Yeah, you've got takeout that's helping out, but there's no entertainment going on. I guess Netflix and what you watch on TV. Then employment by industry. So 1/5, 1 out of 5 Americans is going to be potentially out of a job. I mean, that's horrible. But then you look up here and you think, wow, it's only 7% of operating earnings for the S&P, and it's 1 out of 5. What this tells you is the margins for these industries were very thin to begin with. Now they're shut down. It's a huge problem. And like restaurant and bars, so we open up our economy. Okay, you're going to have probably social distancing. People are going to be wearing masks. So how in the hell do you go out and eat if you got a damn mask on? Everyone's going to have like a smoothie bar. You kind of stick a straw on the side of your mouth. I mean, how's that going to work? And the airlines, they pack you in like sardines. How are airlines going to do that? And we know, well, not we know, but it's going to be known soon. The coronavirus is an aerosol. It does travel through the air. It's not just droplets. And you're probably seeing more and more stories about airlines and pilots, people who are breathing this air that are catching the virus. And I just found out something today. One of the guys in my Bible study on Thursday, he flew back from Oregon. He has some property up there. DFW instituted a new rule. I did not know this, that if you fly on a plane, you land in DFW, not from New York City, New Orleans, but anywhere, you have to go through a mandatory 2-week quarantine. And if you violate that, you will have a $1,000 fine and possibly go to jail. And they're going to have a sheriff constable come by your house periodically, night and day, to make sure you're there. If you're not there, you're going to get tagged. So it's that's kind of scary. But we need to help out these people here. And again, a lot of you are doing takeout restaurants and give these people good tips. I think it will make a big difference. Now I want to talk a little bit about. Go ahead.
We should just take those resources and round up the criminals. Why weren't we already doing that? What the heck are we waiting for the virus to do that for?
Yeah. Next slide. This is the CARES Act, and a lot of people got the stimulus checks yesterday in the mail. And one thing I thought was a little disingenuous, I didn't realize this, and I saw it on the news and Googled it. Well, the checks are signed by Donald Trump, and then in the press conference yesterday said he didn't know that was going to happen. Yeah, right, Donald. I mean, don't lie about that stuff. I mean, yeah, it's a great political ploy, but why did he have to sign it? Why can't Mnuchin, the Treasury Secretary? So we know what's going on there. But at least people are getting money. A lot of people were saying the government would never get the money out as quickly as it did, and this is going to really help a lot of Americans. So I'm happy to see that money got out. Unemployment benefits. One of the things you can relay, I was on my Vistage call earlier today, and if you call the ombudsman at the TWC, you can get through. Don't go on the website. Don't call the main number. You can't get through. So anyone you know that's unemployed, have them reach out to the ombudsman with the Texas Workforce Commission. That will help kind of cut through the red tape. Loans to distressed businesses. These are for the large businesses, $510 billion. Here is the PPP program, Payroll Protection Plan. This money as of today is gone. And just to show you the significance of $377 billion, the banks that made these loans, it took them 14 years to lend out $377 billion. They went through this money in less than 14 days. And there's current legislation pending to add a second tier to this. It was originally going to be $250 billion, and they were going to do I can't remember what the vote is, but just like a yay or nay. It was a one-page document, and Nancy Pelosi and Chuck Schumer said, no, we can't do this. We want more money for these other areas, and they were going to raise it to 600, and it's still, we're not sure when that's going to be passed. And Tab, you want to share a little bit about what you found in your research for the delay?
Yes, so the Democrats are trying to delay it because they want to do another $250 billion, but the Democrats want them to add an additional $1 billion for hospitals and $150 billion for state and local governments to boost food assistance funding. They also feel like there should be a little bit more stipulations instead of just releasing the money. Similar to kind of what we are seeing in some of the clients that have reached out to us, they don't want it to just be the big banks that are doing the lending, because a lot of the people who've applied, if they didn't have outstanding debt with those banks, they were running into problems if they didn't have loans with them already. So they want it to be available for some of the smaller local banks and to be available for family businesses, women-owned, veteran-owned. So they just want it to be available for some of the smaller businesses. They feel like a lot of the bigger businesses with less than 500 had access to that money first.
That's great, and that's true. We're a small business. I bank with Wells Fargo, and I got my initial app in day one, and I finally got a notice yesterday that you could go ahead and do the formal application. So I get it in last night. Then before noon today, the money's gone. I heard that Chase was one of the big banks that got some of the loans out. I haven't heard much about Bank of America, but the local community banks shelled out quite a bit of this money. But that rule about having loans with a bank, so if you run a business, you don't have a lot of debt, you're going to be penalized. So I think some of those points that are brought up make sense. But this program is really going to help a lot of the small businesses, especially look at the hospitality sector. It can really help these businesses, stay afloat long enough until the economy can be reopened. Mike, do you have any comment on this?
Yeah, it's extremely frustrating. So they have this line item in the bill that says $377 billion. They put a line through it and changed the number to $600 billion. That was the proposal. It was a one-page sheet. It was about to pass unanimously, and Nancy Pelosi sent her representative down to the floor and objected to it, and it killed the whole thing. I don't know if you guys recall when the CARES Act was ready to be passed, it took Nancy Pelosi a week before she put it in front of the House of Representatives. And I don't Tab made some really good points. There's other places this money can go, but pass this first and then worry about the next chunk. I don't understand the delay. I feel like there's some sort of gamesmanship going on, and I don't like it.
And my point is, if you look at this last item on the page, 516 billion, other spending and tax breaks, put the word pork next to this. That's what this is. Why don't you just take the money out of this part of the bill, put it up here, then fund this again in the second tranche of the second bill. My frustration with our Congress and some of the actions that's been taken, that over-reliance on the modeling about what the death rates would be, there's some really, really big costs that are going to be becoming really real that I don't think our government is really taking a full look at. So we'll talk about that here in a few minutes. Again, before I go on to the next slide, any of you that have questions, please send those in and we'll address them here in a little bit. So this next slide is showing the contagiousness of the coronavirus and the importance of shutting things down as quickly as we did. So if you avert one case now, and in 30 days or in 20 days, or you do in 10 days, I should say, in 20 days, you have almost 2,300 people who are infected. If you avert just one case now, if you avert one case in 7 days here, that number is a little less than 600. And the reason I'm sharing this with you is this is the danger if we open too quickly and don't take adequate precautions. This is the potential problem we have. So I'm going to talk a little bit more about that here as we go through the next few slides. Now, this information here came out of China because the fatality rate for COVID in China was 3.4. If you go to the Worldometer site, it's 0.7. Of people who get it, it's actually fatal. The seasonal flu is 0.1%. And then SARS and MERS, which are also were coronaviruses, had much higher fatality rates. The SARS virus burned out. Really, no one knew what happened. But these both were also coronaviruses. Would it be a blessing if the COVID-19 would burn out like the SARS did? And this is just my take and the information I read. I think you're going to see the fatality rate is going to be below 1%. Is it going to be 0.1? Probably not. Maybe it will be in this country. And to put that in perspective, we had 60,000 people die in the 2017-18 flu season. And the projections and the models, a month ago were saying we're going to have as many as 2 million people that are going to die from this. Well, they've continued to ratchet this down, and now they're saying 60,000. And
Mitch,
by August 4th, yes.
I wanted to add to this. Finish your statement. By August 4th, what? I'm sorry.
August 4th is when they say that 60,000 or 61,000 number would be met.
So my dad lives in the Northeast, and I was talking to him today, and he said that yesterday, New York City had 3,700 people die of heart attacks. They all got marked as coronavirus deaths. And I asked him, why did they do that? He said, an overabundance of caution. Why not? The coroner can't go through each one of those and figure that out. So they're just marking that as deaths. And you look on this chart here, and it says 3.4%. That includes the African nation, the South American nations, non-developed nations. So I think it's very hard to get a number. You said you can see that number keep ratcheting down. And I agree with you. Right now, they're lumping a lot of deaths in as coronavirus that I don't think are true.
Yeah, the issue is, are people dying from coronavirus or with it? And there seems to be a bias in the medical community that if you have a heart attack or some other ailment and you die from that ailment, but if you had corona in your bloodstream, it was a coronavirus death. I don't understand the medicine or why that's happening, but I think we'll find out more as time goes on. And this next slide here, it talks about the extremely low chance of dying if you do not, I repeat, do not have pre-existing conditions. This is 0.9%. And what they're finding is with this disease, if you have heart disease, diabetes is a really big one. COPD, high blood pressure. If you're a cancer survivor, your immune system has been impacted, you have a much higher risk. And the other part of this is a lot of these diseases are a result of being morbidly obese. BMI index over, Tab, is it 30 or 40 in terms of the BMI index? So if you are overweight and out of shape, and you probably have one or more of these other diseases, COVID's going to hit you a lot harder than others. And the other thing that's really scary is that the fatality rate for people who go on ventilators is about 80%. Only 1 out of 5 people who go on a ventilator are going to survive. Candace, my wife, the people that own her clinic, Sally and her husband, they went on a trip. They both got COVID-19. Her husband was hospitalized, was on a ventilator, did survive, came home, and now has an oxygen tank he has to carry around with him because of the damage to his lungs. And I just found that out today. So this can be a very dangerous disease. I don't want to minimize it, but we have to look at the cost of a small fraction of our population versus the cost to the majority of our population. And this next slide, and this is going to get a lot more press as we start opening up. There's 2 different kinds of scenarios, and we don't know which one we're going to be. We're only going to know this as testing becomes more commonplace, and that's one of the key things opening up successfully. You have 2 scenarios. Scenario A basically says you have infected but unknown people. They're asymmetric, or they haven't been tested, but they had it and recovered from it. The infected and known, they've been tested and declared, but the majority of dots are white. These are unaffected people. So is this what the United States and the world is going to be, or is it going to be scenario B? B is the ideal scenario. These are a bunch of people that already have the antibodies because they've already got the disease and recovered, and they're going to have some immunity built up for a period of time. Now, I know in South Korea, there was a study done, 175 patients, and the people who had just a mild case of it didn't have sufficient antibodies to ward off another attack. So, and again, the medicine is still being developed and science is being looked at. But, if the scenario, if we get antibodies testing, which I think is going to be the best thing short of the vaccine, if we are a scenario B as a public, we're much better shape than scenario A, because scenario A, we have the risk of the bigger flare-ups. So this is something you guys will probably hear more about in the next few weeks. What can you do to beat this? I've always taken supplements. This is vitamin D here. This is, I'm not sure how this is pronounced. There's a product called NAC that I take, and then zinc. I take some other multivitamins. I've only had the flu once in 20 years, and I was only down for about a day. Elderberry is a very good antiviral, you can, I don't call it medication or supplement. It really works well. And I've taken this for years when I feel like I'm getting a cold. And I'm normally, maybe I feel bad for a day or 2, but I'm well. And the medical community doesn't want to recognize this because Big Pharma doesn't want the competition. But in addition to these, there's another vitamin you should take in addition to is vitamin C. And this next page here is a supplement. So they talk about zinc, this quercetin, and vitamin D. And vitamin C, if you take the powder version, put it in your water you drink throughout the day, and people say, how much vitamin C should you take? And if you're in a high-risk category, take as much until you start getting diarrhea, and then you're taking too much. And then if you get a tickle in the throat, take some elderberry. You don't take elderberry all the time. Just take it when you feel like you're getting sick. If you get COVID, you can see this here. The NAC is this medication. Now, I want to be really, really clear. I am not a medical doctor. We're not giving medical advice. This is just some advice from one of the sites that we go to. And my own personal experience has been this stuff does work. And I know there's evidence out there. So what I would suggest is do your own research, talk to your doctor, talk to your chiropractor or wellness doctor or person, and find out information for yourself. So as we kind of wrap this up, we've got 3 more slides here. I'm going to talk about the cost if we open too soon. Obviously, we could have a spike in new cases. And guys, we're going to have it. It is going to occur. It could overwhelm the health system. New York City got very, very close to being overwhelmed. They got up to the peak, that leveled off. Now on the downside of the curve. Cuomo announced they're going to extend their shutdown until May 15th. The second point is if we do have a big spike and we have to have a secondary shutdown, like we're about a month and a half or a little over a month into this one, how long will the secondary shutdown last? Is it going to be 45 days, 60 days? It could be devastating to businesses that are on the brink right now. So that could be really, really bad. The other issue is we're going to have a lack of uniform processes, inefficiencies, and delays. Some cities and states, particularly out west in rural areas, are going to be able to open up sooner, but you have people traveling back and forth, and maybe some of the metropolitan areas are still in the lockdown. I know that the Texas Highway Department is pulling people over who have out-of-state plates, and they're basically telling them they have to quarantine. I'm not sure how that's being enforced, but they're trying to minimize the spread. So there's going to be some challenges. People that have kids at home, they go back to school. The schools haven't had food in them for a month and a half, so the kids go to school, and there's no food to feed them, and there's some of the supply chain is going to be messed up. So there's going to be some inefficiencies. But these are the main costs that we see of opening too soon. I think the cost of not opening quick enough far outweigh the cost of opening too soon. Record number of Americans are unemployed. They're going to get some unemployment benefits, but again, going back to that chart, 90% of Americans spend 100% of their paycheck. People's stress level is going to continue to be elevated. That's going to cause mental health, depression, other health issues. And part of this other part on health, there's a lot of surgeries that have been put off because they were elective. They say, yeah, I need to have your gallbladder out. You can wait a couple months. Well, you wait too long, you're going to get jaundice and have issues. Substance abuse is going to be increasing. Why do you think the governor's allowing all the liquor stores to stay open? You have people that are self-medicating. You have people that abuse drugs or use marijuana because of their stress. That's their coping mechanism. Some businesses, especially in the hospitality sector, within margins will never recover if we don't open. Then you're going to have this domino effect. So these restaurants and bars and hotels aren't paying their rent. The banks that have the liens or the mortgages on these institutions are now going to be foreclosing on the building owners. So that's going to be the second domino. And then the banks are going to be getting in trouble because they're going to have a bunch of foreclosed property. Look at 08, 09. And, for the older people on the call, remember the S&L crisis of the late 80s. This is a huge one here. And poverty is one of the biggest reasons why people die. And you look at the third, fourth, and fifth world nations, poverty is a huge problem. I can't remember the statistic, but I think it's 800 million people a year die because of poverty. Tab, I don't know if you have any figures on that, but it is a huge number. So if we're not working, we don't have money, we're pushing people back into poverty. Education setback for students. Say you're a couple and both of you are working, or maybe one of you is working, and all of a sudden you got your kids and you have to be a teacher. Well, some people are very good parents, but they're probably not good teachers. And if you're having to teach something more advanced, like calculus or trigonometry, and you've been out of school a few years, that's pretty dang hard to teach. And the other problem is these kids aren't learning. The Richardson Independent School District, I went to Richardson High School, is now doing pass-fail. So these kids that are achievers, what's their motivation to even do anything? They're already going to pass. See, we're setting our kids back the longer we keep these schools closed. It's also been shown that children seem to have better immunity to the COVID than people that are older. And then you've got the problem is, okay, the kids go to school, and then maybe you have a grandparent living with them who may be at a higher risk. So you got that challenge. This one here is also being very underreported. 1 out of 3 women have been or are in a relationship that's abusive with a partner. That comes from the family place. And if you're cooped up with someone who's abusive, you can't get away from him. It's making it incredibly difficult. When you look at the number of calls family places getting, and then suicide helplines up here with the mental health and depression, they can't answer all the calls. I mean, these people are just inundated, and this is going to continue to get worse the longer we stay shut down. And then the last point here is increased crime. Some of the larger metropolitan areas are trying to thin their jails to prevent COVID from spreading throughout the jail population, then spreading to the jailers, the constables, and the people that run the jails, which makes sense. But how do you like having a bunch of criminals running around on the street? Now, they say they're not releasing the violent offenders, but who's really doing the checking on that? And then also in a lot of these same areas, the politicians in these states are saying, well, we need to shut down the gun stores. That's not a necessary business. So you think, and that's not happened here in Texas, but I know it's happened in California, in I can't remember the other states that it's happened, but it's a huge problem. We can't defend ourselves. We can't get guns or ammunition for our guns, and we have a lot of criminals running on the street. And guys, I can just tell you, Castle Hills, which is a suburb by Louisville, not too far from Capel, one of my friends lives there, and he and his wife would take evening walks, and he started carrying his handgun because he saw a lot more cars broken into. And if you think about it, if you've got teenagers at home, it's already difficult to have teenagers. Now they can't go to school, they can't play sports, they can't do cheerleading, can't do drama, their schoolwork, and they can't work. So what are they going to do? And the ones that were maybe kind of, the ones that would get in a little bit of trouble, and they're going to get in a lot more trouble, and especially if money starts getting tight. So these are some big costs of what people may incur.
Mitch,
so what are the keys? Yes.
I have two little kids at home, and I can tell you that there's no shortage of drama. You had thrown that in there, but no, there's plenty of drama still.
Yeah. Thanks, Mike. Okay, so the keys to success. The key for this is going to be widespread testing, and the antibody testing would be the gold standard. And Abbott Labs, a friend of mine works for Abbott. He helps build some of the medication build some machines that's going to be used for antibody testing. He got an email from their CEO yesterday announcing this big rollout, and my comment back to him is, how many machines and when? Because once we know, are we in scenario A or B, then the people that are healthy or have had this already can go out and do work, and we can open up businesses more quickly. I think you're going to see in the next few days more conversations about antibody testing, so we can open up much more quickly. When you go out, wear a mask. I've talked about that before, the social distancing, 6 feet. I think you're going to start to see scanners for temperatures at entrances for any kind of large gatherings. So if you're going to like a ball game or a concert, anywhere you're going to have a large number of people, and also malls and stores. I heard Walmart's going to be doing this, and if you're above a certain temperature, the security guard's going to pull you aside and say you need to leave. And then I think also you're going to see happen here is some kind of standardized reporting of your health status. You're going to probably have an app on your phone that you have to show to wherever you want to go to that you are, either not been sick or have been sick and you have the antibodies. And then you're going to see the continued fast tracking of medical treatments and vaccines. There are 10 vaccines in the pipeline. And some good news here is the COVID virus hasn't mutated as much as like the regular influenza virus. So what that means is the vaccines that are in their trial phase, they're not going to have to modify and start over as they often have to with other vaccines. It's only mutated twice. And fortunately for us, the latest version of the COVID-19 virus is less lethal than the original version, but it's been somewhat stable. So that's really good news. You hear a year, 18 months. I personally think, just from what I've read, I think we're going to have something by the end of this calendar year. The CDC recommended, as we open up the businesses, you guys can do this in your homes as well, especially if you have someone that's higher risk. Instead of putting your thermostat on auto, put it on high, and change your filter instead of on a quarterly basis or 6 months, change it maybe monthly or every 6 weeks. And obviously, if you're sick, stay at home. People are already going to be pretty scared as we kind of re-enter. A lot of people are going to still stay at home. The people that are at risk are going to be sheltering at home. I don't think I have to tell those of you on the call that fall in this category, just because it's open and you can go to a restaurant or a game, I don't think you're going to be one of the first people in line. Here's the website here for donations to the North Texas Food Bank. And we're going to put this in the Orion underneath updates. If you want to take a picture of it with your cell phone now, if you want to do that, you can. So these are keys to success. I'm going to answer any questions. Tab, do we have any questions before we go into the wine part?
Let's see, we have, nope, no questions at this time.
Okay. Let me look at this. Okay, well, fantastic. Well, if you guys would enter questions, go ahead and put those in. I'm going to turn this over to Mike, and we'll start doing the wine tasting part of it.
Okay, so for anyone who does not want to participate in this, close out